February 1, 1991 Real Estate Capital Basics, Underwriting Equities. Important real estate equity underwriting parameters are identified as follows. Property types. Multifamily, apartments, including affordable, luxury, manufactured housing communities, age-restricted, senior living, and student housing. Net lease, all property types acceptable for credit-tenant facilities. Conventional commercial properties, industrial, warehouse, manufacturing, flex/tech, self-storage, office, medical, and retail, mall, community, neighborhood and specialty centers, mixed-use and parking structures. Non-conventional, lodging, healthcare and recreational, golf course, waterpark. Capitalization rates. Static yield calculation applicable for properties with proven cash flow history. Based on stabilized net operating income divided by current value/purchase price. Property preferences continuously change based on supply and demand factors, investor preferences, local and national market perspectives, technological factors, financing availability and a multitude of other variables. Multifamily, current the most desirable of all property types, trading on the lower end of the capitalization rate range, often at or below mortgage rates due to income growth potential and demand. Affordable and luxury apartments trade on the lower end of the range and student housing on the higher end due to management intensiveness. Cap rates often lower than other property types as a result of agency lending programs, FHA/HUD, Freddie Mac and FNMA, priced below overall conventional market debt. Trading range starts at about 50 basis points below conventional mortgage rates for Class A, Core, properties. Older, Class B, Core Plus, properties and secondary locations trade at premiums of 100 to 200 basis points more. Net lease, trading at lowest mortgage rate spreads using conventional market debt. Directly tied to credit-tenant lease quality and term, and physical quality, age and other normal pricing determinants are subordinate to cash flow characteristics. Shorter-term leases of 10 years or less trade at premiums of 100 to 200 basis points or more. Conventional commercial properties, 50 basis points or more above base rate conventional mortgage interest rates for Class A assets. Wide variation of capitalization rates within various sectors and locations. Major markets CBD and urban infill mixed use, parking, office and retail along with newer industrial distribution properties reflect the lower end cap rate range. Other conventional properties and secondary markets trade as much as 300 basis points higher. Non-conventional, 100 basis points or more above conventional mortgage rates for Class A properties. Pricing differentials are similar to conventional commercial properties. However, dramatic pricing variations commonly occur within this subsector of property types, as much as 700 basis points, in some cases, especially recreational and management-intensive healthcare. Most to-be-built properties require at least 50 to 200 basis points premiums to cover uncertainty, cash flow quality, pre-leasing, and property type differences. Current yield. Preliminary indication yield only, more reliance on overall yield. Calculated using annual pre-tax cash flow, adjusted for debt service payments, divided by current value. Applicable for existing properties with stabilized cash flow and proven operating history. Greater than or equal to mortgage constant versus mortgage rate as in the case of capitalization rates for appropriate property type. May or may not be equal to capitalization rate, unleveraged yield, depending upon projected cash flow dynamics. Lower yield indicates more weight placed on reversion and overall yield. 50 basis points or more over return on cost yield, stabilized net operating income divided by total project cost, for new construction ventures. Overall yield. Discounted cash flow analysis using net present value and internal rate of return are the most common calculation formats. Longer-term holding periods quickly consume overall yields with value creation and speculation thresholds requiring highest returns and shortest holding periods. Unleveraged and leveraged yields substantially overlap due to varying investor and leverage expectations. Unleveraged, 300 to 500 basis points for Class A multifamily, net lease and conventional properties over comparable term mortgage rates, 500 to 700 basis points for Class B properties. 400 to 600 basis points for Class A non-conventional properties over comparable term mortgage rates, 600 to 800 basis points or more for Class B properties. Leveraged, 400 to 800 basis points for Class A multifamily, net lease and conventional properties over comparable term mortgage rates, 500 to 1,000 basis points for Class B properties. 600 to 1,200 basis points for Class A non-conventional properties over comparable term mortgage rates, 1,000 basis points or more for Class B properties. Pricing exceptions apply for unique trophy properties in most categories. Except in rare instances, for example, net lease properties with flat cash flows, annual income and property values are expected to increase during the holding period. Overall yields should therefore exceed current yields. Term. Holding periods targeted towards owning real estate as an investment instead of ongoing development/construction as in the case of builders. Planned holding timelines often change in light of dramatic changes in financial markets including unexpected price increases or decreases. Short term, 3 years or less targeted for value creation. Term is suitable for new construction, rehab and value speculation. Investors include developers, speculators and short-term public or privately syndicated funds. Medium term, 3 to 5 years targeted for more patient value speculation and longer redevelopment cycles, for example, rehab based on tenant rollovers with medium-term lease expirations. Investors include developers, syndications and other tactical funds. Long term, 5 years or more patient value speculation and longer redevelopment cycles, for example, rehab based on tenant rollovers with medium-term lease expirations. Investors include life companies, pension funds, endowments, owner-occupants, rights and other strategic funds. Equity contribution. Availability of financing and pricing influence equity contribution decisions, even if ample funds are available. During tight market conditions more equity is required and the opposite holds true when underwriting standards are liberal. Value creation. Investors seeking highest yields based on maximum leverage target 20% or less equity. Typical ventures for Class A and B properties contribute 20% to 35% equity. Institutional players with longer-term holding cycles typically invest 35% or more. Some major pension funds and other tax-free investors may purchase assets on an all-cash basis, depending upon the cost of leverage. Depending upon market liquidity, seller financing may be available to bridge an equity gap requirements. Investors with strong financial statements will often obtain more leverage from the seller and primary lender as the ability to operate a project appears more secure. Dollar size/investor profile. Investors range from individuals looking for real estate investments to institutional investors who routinely take equity positions in real estate ventures. Some institutions purchase for cash, supplying 100% of the necessary equity, while others leverage their purchases, using debt funds from other sources. Insurance companies have long been a major force in the real estate lending industry. Recently, however, they have become less willing to accept fixed yields on the funds they commit to real estate ventures. In order to increase the return on their portfolio of real estate investments, they purchase property to benefit from expected increases in cash flows and property value over the life of the investment. Under $5 million governed by local players with hands-on management including families, contractors and adjacent property owners seeking more real estate diversification. Mostly casual or part-time investing with limited financial sophistication. $5 million to $30 million attract professional local and regional players having market presence in the general area. More sophisticated financial analysis and full-time resources dedicated to operations. Funds usually syndicated, often including wealthier individuals. $30 million or more attracts institutional investors hiring professional management. Larger publicly traded and private investment syndicates emerge as common players. Special considerations. The cost of financing, 9.5%, is below the unleveraged yields, so leveraged yields will be greater than unleveraged yields.